Welcome to The Explainer. Today, we're diving into some absolute game-changer concepts from Franklin O. Ochoa Jr.'s book, Secrets of a Pivot Boss. We're going to focus heavily on the Camarilla equation. If you've ever felt like the market is just completely chaotic, well, the book presents this equation as an incredibly powerful blueprint for predicting market moves. And we're going to explore exactly how all of it works, from the standard formulas to advanced concepts like hidden layers and the DC3 indicator. Let's start with this fantastic quote from the legendary Jesse Livermore. He said, "When I couldn't play according to my system, which was based on study and experience, I went in and gambled." The author uses this exact idea to highlight why a structured system like the Camarilla equation is absolutely crucial. It's designed to stop you from undisciplined market gambling by giving you built-in entries, hard stops, and clear targets. So here is our roadmap for today. 1. Demystifying the Camarilla equation. 2. Mastering third-layer reversals. 3. Navigating fourth-layer breakouts. 4. Predicting tomorrow with DC3. 5. Two-day pivot relationships. And 6. Hidden layers and trends. Let's get into it. Section 1. Demystifying the Camarilla equation. Okay, let's look at the raw math behind the blueprint. Discovered back in 1989 by a bond trader named Nick Stott, the basic premise takes the previous day's high, low, and close to calculate 8 key levels. The whole philosophy here, as detailed in the book, is that time series data typically reverts back to the mean. So it's literally math designed to highlight the exact areas where price action will likely be forced right back into a perceived area of value. And it is honestly fascinating to see how those calculations translate into 8 perfectly structured support and resistance levels right on your chart. You've got 4 support levels, L1 down to L4, and 4 resistance levels, H1 up to H4. Now, the equation demands you recruit your inner discipline, because the calls to action at these specific levels are always exactly the same. No guessing. Moving on to the expanded Camarilla equation, the author adds a 5th layer, so L5 and H5, and these serve as your breakout targets. The distinct color-coded zones tell us exactly what to do. The 3rd layer, H3 and L3, act as your reversal zones. The 4th layer, H4 and L4, well, those serve as your breakout zones. The book explains how this specific map aims to take the guesswork entirely out of the equation. It's a structured cheat sheet. Section 2. Mastering third-layer reversals. To really grasp this strategy, you absolutely have to understand the market psychology the author outlines. Think about it. Are responsive participants stepping in to push the price back to value? Because that's what drives a third-layer reversal. Or are initiative participants stepping on the gas and aggressively forging new value? That's what drives a 4th-layer breakout. Knowing exactly who is in control dictates your entire approach to a trade. Check out how clean an L3 reversal trade can be. When the price drops to test that L3 support, responsive buyers often jump right in, seeing a bargain. According to the method, this provides a crystal clear entry at L3. The system then dictates placing a strict stop just below L4 and setting your target all the way up at the H3 resistance. The risk to reward isn't a guess, it's built right into the structure itself. Section 3. Navigating 4th-layer breakouts. So what if the price slices cleanly through that L4 pivot? Well, the psychology has completely shifted. Initiative sellers have taken total control, and they are seeking lower value. The book describes this as creating a textbook breakout trade. The strategy here involves entering on the break of L4, you keep your stop up at L3, and you ride that downward momentum right down to the expanded L5 target. Section 4. Predicting tomorrow with DC3. Enter the Developing Camarilla 3, or the DC3 indicator. This is a really cool advanced concept developed by the author that dynamically updates throughout today's session. It's constantly crunching new data to forecast exactly where tomorrow's crucial L3 and H3 levels are going to be established. Look at this. As price moves throughout the day, the dynamic wavy lines of the DC3 adjust based on the incoming data. But the absolute key is to pay close attention to where they close at the end of the session. Those final closing values literally become the flat, static boundaries, the actual L3 and H3 for the very next trading session. It's essentially an early warning system for support and resistance. And we don't just look at where the lines are, we actually look at the distance between them. By analyzing the pivot width between these developing L3 and H3 levels, the book suggests we can anticipate upcoming market behavior. If the pivots are unusually wide, we can confidently forecast a choppy, sideways trading range day. But if they're extremely narrow, that signals the potential for a massive breakout. Section 5. Two-day pivot relationships. Armed with tomorrow's predicted levels, the source material outlines 7 specific two-day relationships. Think of this list as a cheat sheet for market sentiment. We have higher value, lower value, overlapping higher value, overlapping lower value, unchanged value, inside value, and outside value. Each single one tells a very specific story about where the market might try to go. Visualizing these relationships as simple blocks makes it super easy to digest. For example, if we look at the lower value relationship, tomorrow's block is completely below today's block. According to the author, that gives us a deeply bearish bias for the upcoming day. In that exact scenario, the strategy is to look to sell any pullback up to the H3 pivot. It's all about preparation based on structure. Now, the book points out that one of the most explosive setups is the inside value relationship. This happens when the DC3 predicts a very narrow range entirely inside the previous day's range. It essentially coils the market up like a tightly wound spring. When the market finally opens beyond that range, it can unleash a massive, unstoppable initiative breakout. Anticipating this specific relationship allows a trader to be perfectly positioned for a breakaway move. Section 6. Hidden layers and trends. So, what if the previous day's range was absolutely massive? Today's L3 and H3 are going to be spaced incredibly far apart, sometimes way too far for price to even reach. When that happens, the system activates the hidden layers, which are H1, H2, L1, and L2. The author uses a great analogy here. It's kind of like a swimming pool. You don't always use it, but on a nice, volatile day, it's a fantastic place to dive in for internal reversal trades. When stepping back to look at longer-term trends, the Camarilla pivots take on a whole new role. The author calls this the police barricade effect. In a firmly established trend, these pivots act like crowd control, efficiently catching those pullbacks. They provide solid support in an uptrend and stiff resistance in a downtrend, helping to keep the broader market moving in its intended direction. As we wrap up this explainer on the Camarilla equation, I want to leave you with this final crucial thought based on our exploration of the text. When analyzing the market, are you going to continue reacting blindly to the immediate, chaotic price action? Or are you going to leverage the math, the DC3 indicator, and these two-day relationships to map out tomorrow's structure before it even begins? Exploring these tools absolutely offers a fascinating structural perspective. Thanks for joining me.